Howdy, Jacob here. Today we're looking at Bruker Corporation in the life sciences tools and services industry. Just under 10 billion market cap, just under 11 billion enterprise value. Figures look very good on the revenue side, solid increases, maybe 5 to 6% compound annual growth rate. A lot happened in the last 3 years. It was relatively flat for about 7 years and then very good growth the last 3 years. That's the same on the margin side, except they were increasing. Both of them were increasing, but the last 3 years, it's the highest it's ever been with 50% gross margin and then high teens in the operating margin. Been paying a dividend, but it's just 20 cents a share, very much nothing or pretty much nothing in relation to their earnings per share. And return on invested capital, very solid, well above 10%, creating business. That's awesome. Balance sheet shows 488 million cash on hand, 121 million short-term debt, 1.2 billion long-term debt. So let's look at roughly a billion in relation to the free cash flow is not a whole lot. I mean, it's definitely a decent amount, but um, they do have a good amount of cash on hand as well. So if we do net that out, it's maybe 800. Or I guess let's do it. So about 1.2, 500, 700, 800. So 800 is about 4 years. Their 5-year average free cash flow. Not terribly concerning. It is a good amount of debt, so we are going to have to put in to our assumptions maybe 10-20% of their free cash flow goes towards debt reduction. But this business is very likely increasing their free cash flow, making that ratio less due to the fact that they're increasing their free cash flow. So the numerator of free cash flow over debt, as long as they keep the debt the same, should be fine. And I can't really understand why they went into debt for this. They made $200 million, bought back shares, made acquisitions and reinvestments. So that's kind of interesting that they just issued debt for that. Same with over here, but really it's going to get to a point where, you know, the debt is fine right now, but really just to grow organically. There's really no problem with that. And I think that they could easily still put in very solid revenue growth and margin expansion with the business they have at hand. So a lot of their money is going towards acquisition, reinvestment. Their dividend pays out 29 million, which is maybe 15-20% of their 5-year average free cash flow, and a good amount to share repurchases. So this company is definitely using all of their capital allocation avenues. We'll just have to see whether they're doing some of them advantageously or not. On the revenue growth side, I think that to me 6% seems pretty reasonable. They do have a slight. I'll put them at a slight increase above the market at the end of 7 years, saying that the growth will probably be similar to the market, but I do think that this return on invested capital being as high as it is an advantage. For margins, let's do 11 and 9%. Share repurchases, 1% would be about 10. Would be about 100 million. Sorry, 100 million, 123 to offset stock-based compensation. I think that seems reasonable. The dividend, they haven't increased it, so why should I? So this is saying about maybe 40% of their free cash flow is going towards share repurchases, maybe 10-15 to the dividend, 20-25 to 15 to 25 to debt reduction, and then the rest reinvestment, acquisition to get a 6% return a year for the next 7 years, and then these types of margins. And we're saying the stock price needs to fall 68% before you get the return we're looking for here. So I do think that it's an interesting company. I think that, not the best I've ever seen, but definitely a solid business, but just not at the price for me that makes sense. So hopefully that, you enjoyed the analysis. Hopefully it's another company you can look at, and I hope you have a great rest of your day. Thank you.